Have you ever looked at a stock chart and wondered, yeah, price actually decide kaun karta hai? Is it some big institution, a mysterious algorithm, or some secret formula? Today, I'm going to break it down for you in the simplest way possible. Welcome back, traders! In this video, we're diving into one of the most misunderstood concepts in the entire stock market, how stock prices are actually set. If you've ever been confused why a stock rises one day and crashes the next, or why prices move instantly after news releases, then stay with me. This video will finally give you clarity. Most beginners think stock prices are controlled by brokers, market makers, or big players. Some even believe that the market is fixed against small traders. And I get it. When you're new, the price movements look random, fast, and sometimes frustrating. But the truth is, once you understand how prices are set, everything becomes less confusing, your trades become more logical, and your confidence grows. So today, I want to guide you through this topic the way I teach beginners in my trading workshops. We'll break it down step by step, without fancy jargon, without unnecessary complications, and without those textbook definitions that just confuse you more. By the end of this video, you'll be able to look at a live market screen and understand exactly why price is doing what it's doing. And trust me, this is a game-changing skill. We're going to talk about what actually drives stock prices up or down, why news affects prices instantly, how buyers and sellers fight on the chart, and how you can use this knowledge to make smarter trading decisions. Understanding this isn't just helpful, it's essential. Because when you finally see how price is set, you stop guessing and start trading with purpose. You stop chasing random moves and start reading the market like a professional. And that's how real progress begins. So if you're ready to gain clarity, confidence, and a completely new perspective on how the market really works, then grab a cup of chai, relax, and let's dive right in. This might just be the most important stock market lesson you learn as a beginner. Welcome to the channel. I'm your trading coach, guiding you step by step toward becoming a smarter, more confident trader. Let's get started. Now, before we jump into how stock prices are set, let's talk about why this topic is such a big problem for beginners. Because if you're just starting your trading journey, chances are you already feel confused, frustrated, or even discouraged when you look at the market. And that's completely normal. Most beginners enter the stock market full of excitement. They see others making money, they watch charts moving up and down, and they think it can't be that hard, right? But the moment they place their first trade, reality hits. The price suddenly moves against them, their stop loss gets hit, a breakout fails, a pullback reverses, and they start wondering, who's controlling all this? That confusion isn't your fault. In fact, the biggest problem is that nobody explains how price is actually created. So beginners make assumptions, they believe myths, they blame brokers. They think the market is against them. And because of that misunderstanding, their trading decisions become emotional instead of logical. Let me share some common struggles beginners face. 1. Thinking the market is manipulated against small traders. When you don't understand how prices move, it's easy to believe someone is targeting your trades. You feel like every time you buy, the market falls. Every time you sell, the market rises. This creates fear, hesitation, and a lack of trust in your own strategy. 2. Not knowing why price suddenly spikes or crashes. You might see a candle shooting up or dropping within seconds and wonder, why did this happen? Without understanding price mechanics, it all seems random. And when something feels random, it becomes scary. 3. Getting trapped in bad entries. Beginners often buy too late or sell too early because they can't read the pressure between buyers and sellers. They react to candles instead of understanding what's happening behind those candles. 4. Overthinking news and reacting emotionally. Many new traders panic when a news headline comes out. They assume the news creates the price. But in reality, news only triggers changes in supply and demand. Without knowing this, beginners overreact, exit too soon, or jump into trades blindly. 5. Feeling overwhelmed by technical indicators. Most beginners try to use dozens of indicators, hoping one of them will predict where price is going, but indicators only reflect price. They do not create it. Without this clarity, traders end up complicating their charts and their decisions. And the sad part is all of these problems come from one root issue: not knowing how stock prices are set. Think about this for a moment. Would you drive a car without knowing how the brake or accelerator works? Of course not. But many beginners trade the stock market without understanding the basic engine that drives everything: price discovery. This lack of understanding leads to fear of entering trades, impulsive decisions, random entries and exits, confusion during volatility, and ultimately losing money. But here's the good news. The moment you learn how price is actually determined, the moment you see how the battle between buyers and sellers works, everything becomes simpler. You stop fearing the market. You stop guessing. You stop relying on luck. You begin to read charts with confidence because you understand the logic behind them. And that's exactly why this video is so important. Because once you understand how stock prices are set, you will finally have a foundation, a solid base that guides every trade you take. Alright, now that we've clarified the problem, let's move into the most important part of this video: how stock prices are truly set, step by step. Alright, now let's break down exactly how stock prices are set step by step in the simplest way possible. No jargon, no confusing textbook definitions, just a clear explanation you can understand immediately, like I'm teaching you one-on-one. Most beginners think stock prices move because of indicators, chart patterns, brokers, or even manipulation. But the truth is far simpler. Stock prices are set by one thing: SUPL and DMD. That's it. Every second, thousands, sometimes millions of people are trying to buy or sell the same stock. And the price changes based on how many buyers and sellers are willing to trade right now. Let's break this down into clear steps so you can fully understand what's happening behind the scenes on the chart. Step 1T. The market matches buyers and sellers. The stock market works like an auction. If you've ever bought something online, you know how bidding works. The highest bidder wins. The stock market is similar. Buyers place buy orders at the price they want. Sellers place sell orders at the price they want. The market's job is to match them. Whenever a buyer's price meets a seller's price, a trade happens. And that price becomes the last traded price, which is what you see on your chart. Nothing magical, nothing hidden, just matching orders. Step 20, price moves when one side gets stronger. Imagine a tug of war. Buyers on one side, sellers on the other. Whichever side has more strength wins. If buyers are stronger, they're willing to pay higher prices to secure shares. P price goes up. If sellers are stronger, they're willing to accept lower prices to get rid of shares. B price goes down. This is the real engine of the market. No indicator sets the price. No news anchor sets the price. No chart pattern sets the price. Only the balance between supply, sellers, and demandee buyers. Step 3D. Why news affects prices instantly. Many beginners think news directly changes prices. But actually, news changes how buyers and sellers behave. Example: good news, gear more buyers, gear higher demand, price rises. Bad news, go more sellers, higher supply, price falls. News doesn't move the market. People reacting to news move the market. Step 4, hey, market orders push price immediately. There are two types of orders. 1, limit orders. You set a specific price. Example: I want to buy at 100 DAI. Your order waits until a seller agrees. 2, market orders. You say nu at the best available price. This order consumes whatever is available in the order book. Here's the key. Market orders move the price because they eat through available buy or sell levels. So when big traders use market orders, price jumps or drops quickly. Step 50. Price consolidates when buyers and sellers are balanced. Sometimes the market doesn't move much. That's because buyers and sellers are equal. Supply and demand are balanced, and the market is waiting for something, usually news, data, or a breakout level. This is why you see sideways movement or ranging markets. Step 60. A breakout happens when one side gives up. Whenever you see a breakout, price suddenly moving strongly in one direction, it usually means buyers finally overwhelmed sellers, or sellers overwhelmed buyers. Breakouts aren't random. They happen because one side loses the battle. The big truth, every candle on your chart, every uptrend, every crash, every spike. All of it comes from this constant battle between supply and demand. Once you understand this, trading becomes clearer. You stop guessing. You start reading the market like a story. Who's winning, who's losing, and where price is likely to go next. Now that you understand how stock prices are set through supply and demand, let's bring it all to life with a practical, real-world example. Because theory is great, but when you see it play out on an actual chart, that's when everything makes sense. So imagine this scenario. We're looking at a stock. Let's call it ABC Corp. The stock is currently trading around 100, and for the last several hours, it's been moving sideways between 99.50 and 150. Nothing too exciting. The candles are small. The volume is moderate. It looks like the market is sleeping. But here's what's ACTULY happening behind the scenes. 1. Price is consolidating. Buyers and sellers are balanced. Whenever you see sideways movement, it's a sign that buyers want to buy, sellers want to sell. But neither side has enough power to push price in one direction. Think of it like two teams arm wrestling and holding at the center. Nobody is winning yet. On the order book, buyers have limit buy orders around a 99, then 50 to 100. Sellers have limit sell orders around 105.50 to 101. Both sides are waiting, watching, preparing. This is the calm before the storm. 2. Suddenly good news hits the market. Let's say ABC Corp releases a positive earnings report. Sales increased, profits jumped, new product launch performed better than expected. Now remember, news doesn't move price. People reacting to the news move price. So what happens? Suddenly more traders want to BUY the stock. Demand increases. Buyers rush into the market. Some traders place limit orders, but many place market orders, meaning Wunanbu. I don't care about the price, and this changes everything. 3. Market orders start eating through sell orders. The price is still at 100, but now hundreds of new buyers enter at once. The order book gets hit by market buy orders first. They consume sell orders at 100. Then the sell orders at 100 be done get filled. Then D151 and 150 or 180 suddenly the chart prints a big green candle, maybe all 100 or the 120 in one sharp move. Beginners think, whoa, price exploded out of nowhere. But now you know the truth, price moved because aggressive buyers overwhelm the available sell orders. 4. Sellers back off, buyers dominate. When buyers see a strong move, more buyers jump in. When sellers see price rising quickly, many pull their sell orders back, thinking, let's wait, maybe the price will go even higher. This reduces supply even further. Low supply, high demand, FST price movement upward. This is why trends start. It's not random, it's not magic. It's the real-time imbalance between buyers and sellers. 5. A breakout traders join in. Remember that consolidation between 99.50 to 100 by FFZV. Many traders were waiting for a breakout above a 100 P50. As soon as price breaks that level with volume, breakout traders enter. This adds even more buying pressure on top of the earlier demand. Price accelerates again, maybe from 101 down 2T, go on 102, 103. Suddenly you have a solid trend forming. 6. Eventually, buyers slow down and sellers return. Every move eventually cools. Some traders take profit, some short sellers enter, some buyers stop chasing the momentum. Eventually, sellers begin to push back. Supply increases again, and price either stalls or pulls back. And that whole move from consolidation, breakout a Q trend, was created purely by shifts in supply and demand. No tricks, no manipulation, no mystery, just simple market mechanics. Understanding this example helps you read charts with purpose. You see why price moves. You understand who is in control, and you can make trading decisions with much more confidence. Now that you've learned how stock prices are actually set and seen a practical example of supply and demand in action, let's bring everything together. In this section, I want to give you a clear list of key takeaways and actionable tips, simple things you can start applying immediately to improve the way you read price movements and make trading decisions. Think of this section as your personal cheat sheet. These are the core principles that will help you avoid beginner mistakes and view the market through the eyes of a professional. Let's dive in. Key takeaway NED, price is a reflection of buyer and seller behavior, nothing else. If there's one thing you remember from this video, let it be this: price is not random. Price is not controlled by brokers. Price is not determined by indicators. Price is created by POPE, buyers and sellers. Every push of the market, every move up or down, every trend or reversal, it comes from a shift in supply and demand. When buyers are more aggressive than sellers, price goes up. When sellers are more aggressive than buyers, price goes down. Once this becomes clear to you, trading becomes much simpler. You stop relying on luck and start relying on logic. Key takeaway A to D: big moves happen when one side gets overwhelmed. Have you ever wondered why price stays quiet for hours and then suddenly explodes? It's because major moves are created when one side gives up. Buyers overwhelm sellers, break out upward. Sellers overwhelm buyers, break downward. A. Markets don't move strongly without a reason. There's always a shift in control happening under the surface. This understanding helps you spot breakout opportunities, avoid fake moves, time entries more confidently, understand when not to jump in. Instead of reacting emotionally, you'll read the story that price is telling. Key takeaway ND30: market orders move price faster than limit orders. This is one of the biggest missing pieces for beginners. A limit order waits for price. A market order attacks price. When a wave of market orders hits the market, especially from big players, price moves instantly. That's why news causes fast spikes. That's why breakouts are sharp. That's why volatility feels sudden. It's not magic, it's the direct effect of market orders consuming available liquidity. This will help you understand why breakouts often happen fast, reversals can be violent, fakeouts appear in low liquidity zones, news candles are huge and quick. And when you understand this, you stop panicking because you expect it. Key takeaway when folding: consolidation balance, breakout out imbalance. Whenever you see sideways movement, it means buyers and sellers are matched. When you see a breakout, it means one side has finally won. This simple concept is powerful. It helps you avoid trading inside noisy consolidation, enter when the real move begins, stick to strong trends, avoid getting trapped by false signals. Most beginners lose money by trading in the boring part of the chart, the tight sideways ranges. Professionals wait for the imbalance. You can do the same. Key takeaway: quantify fee. Don't chase price, read the pressure. FOMO is real, but chasing candles is a beginner mistake that destroys accounts. Instead of reacting to a candle, learn to read the strength of buyers and sellers. Ask yourself, are buyers absorbing sell orders? Are sellers defending a level? Is the market showing signs of momentum? Has demand suddenly increased? This mindset shift makes you a smarter, more patient, and more disciplined trader. Practical tips you can apply immediately. 1. Zoom out and identify who's in control, buyers or sellers. If price is making higher highs and higher lows, buyers dominate. If price is making lower highs and lower lows, sellers dominate. Trade in the direction of strength. 2. Pay attention to breakout levels. Breakouts are not random. They reveal where demand overwhelms supply. Wait for confirmation before entering. 3. Avoid overloading your chart with indicators. Indicators lag. Price leads. Keep your chart simple and focus on price behavior. 4. Watch how price reacts to news, not the news itself. You don't need to predict news. Just observe how buyers and sellers respond. These key takeaways give you a full, solid understanding of how the market sets prices and how YOU can use that knowledge to make smarter trades. And that brings us to the end of this video. But honestly, this is just the beginning of your journey toward becoming a confident, skilled, and well-informed trader. If you've watched all the way until now, it already shows me one thing: you're serious about learning the market the right way. And trust me, that's the biggest advantage you can ever have. Most beginners jump into trading without understanding how price actually works. But you just learned the foundation that every trader must know: the truth behind supply and demand, how orders move the market, and why price behaves the way it does. This knowledge alone puts you ahead of thousands of beginners who are still relying on luck, guesswork, or random indicators. So if this video helped you gain clarity, if it finally made the stock market feel less confusing and more logical, then do me a quick favor. Hit the like button. It tells YouTube this video is valuable and helps more beginners learn the right way. Subscribe to the channel because I upload step-by-step tutorials just like this one every week. If you want to grow as a trader, you don't want to miss those, and drop a comment below. Tell me which part of this video gave you the biggest breakthrough. Was it the supply and demand explanation, the order book concept, the practical example, or the tips at the end? Your comment not only helps the channel, it also helps me understand what you want to learn next, so I can create more videos that genuinely move you forward. And before you go, I want to leave you with one powerful thought. Trading gets easier the moment you understand what controls price. Because once you stop guessing and start reading the market's behavior, everything becomes more predictable. Your confidence grows, your entries improve, your losses reduce, and your trading decisions finally start to make sense. Remember, you don't need to be the smartest trader. You don't need fancy tools. You don't need to predict the future. All you need is clarity, consistency, and the willingness to learn step by step. And if you stick with me on this channel, that's exactly what you'll get. Simple, practical, beginner-friendly trading education that actually works. So again, like the video, subscribe, comment your biggest learning. It really means a lot and it supports the channel more than you know. Thank you for watching, thank you for learning, and thank you for taking your trading journey seriously. I'm excited to see your growth, and I can't wait to share more powerful lessons with you in the next video. Until then, stay consistent, stay focused, and keep learning. I'll see you in the next one.